yes, we are in the thick of earnings season, and earnings seem to be ruling the sentiment on the markets, given the fact that you have DCB banks. The stock is surging in trade today, uptick of about in excess of about 8.5% on back of their Q4 earnings. Let's try and dissect and decode what exactly transpired in the quarter gone by and what the street is actually liking. We have Mr. Praveen Kutty, who is the Managing Director and CEO of DCB Bank, joining us this morning. Very good morning to you, sir. Congratulations. A very healthy book coming in for your company, for your bank in the quarter gone by. The loan book growth of about 25%. This was actually supported by segments like CVs, SMEs, co-lending. So can we actually extrapolate that your loan book growth will remain in excess of about 20% in this FY as well? And if you could help us understand which segments are you actually betting on that will lead the growth?
Good morning and thank you very much. It's been a decent quarter. I'm very happy with the growth that we've achieved both on the advances side and also on the deposit side, albeit slightly lower than the advances growth. We've grown by 22%, but there are two very good things about this growth. On the deposit side, it's come with the right kind of granularity. Our top 20 ratio continues to be less than 7%, it's 6.61%. And on the asset side, in an environment where there are headwinds, and you can't deny that, our gross NPA has come down, our slippage ratio has come down, and overall provision cushion. We have an operating profit of 5 times, slightly more than 5 times the provision coverage that we had. Will this growth continue? If you were to see the last 4 quarters, you've seen that quarter after quarter we have been growing near about 20%. I tend to presume that we would continue in the same trajectory. There's a lot of work happening to bring in a bit of predictability and consistency in what we do. My belief is that we'll continue on the same trajectory where top line and the operating profit march in goose step and have a tight rein on the credit costs.
Good morning, Mr. Kutty. This is Snehi also joining in. Let's talk about your net interest income growth this year, because that has remained as roughly 10% in quarter 4. If we talk about your cost of funds, that has also gone up by 14 bips sequentially. Now, what we're hearing from many of your peers is that they have cut their deposit rates in response to the recent rate cuts coming in from the RBI themselves. Tell us what you are penciling in, how much of an impact can we see on the back of these rate cuts, and are you also planning to cut deposit rates yourself as well?
So, if you were to look at the NIM, it has gone down by 1 bip between quarter 3 and quarter 4. We were 3.3% in Q3. Now we are at 3.29. So there has been a 1 bip impact so far. And we've had a repo rate cut from 650 to 625 in that particular quarter. So we have made some adjustments on our savings account rate as well as the bulk TD rate and retail TD rate. Both in Q4 and also subsequent to the current rate cut, we made some movement on the which will have an impact on the cost of fund. Some immediate, but mostly it will have a trail benefit coming in over the next 12 to 15 months. On the asset side, we've tweaked our product mix in such a way that there is a preference for higher yield products within the framework, the credit framework that we do. We are not into unsecured lending in any big way. So we're keeping the template the same. We intend to do more of overdraft and more of LAP over home loan and co-lending. So probably in the coming few quarters, you would see more of organic loans coming through as compared to co-lending. So there will be a skew in favor of higher yield products within the credit framework which we have, the business strategy that we have adopted.
let's talk about your NIMs, because in the quarter gone by, your NIMs were around 3.3%, around 3.29%, and you are aiming for NIMs to be approximately in the range of 3.5 to 3.65%. Do you think that this sort of an expansion in your NIMs will be achievable? And if so, then if you could help us understand and decode for us, what would be the key levers that will actually lead to this expansion for NIMs?
See, right now, we're looking at a NIM stabilization in the wake of 2 rate cuts that we've happened. Going forward, on the immediate basis, there has been some cuts on the savings account rate, which is an immediate impact. There has been some reduction in your retail term deposit. More than 75% of our book, our liability book, is term deposit. There has been a reduction, but that will not be an immediate pass on, because typically more than a year-old, year tenor loans. So you'll see the benefit of that happening over a period of time. On the asset side, like I mentioned earlier, there is a proclivity. There is the engine is tweaked to get a higher yielding secured product like a LAP, perhaps over a similar product like a home loan that we are currently doing. Also, in a product mix change, the proportion of co-lending growth would be lower in the coming quarters as compared to organic loans that we do. These are the 4 steps, 2 steps on the asset side and 2 steps on the liability side that we're doing to ensure that NIM is stabilized and it expands to where we want to be over the next 3 to 4 quarters. But it's important to tell you that in case there are any further rate cuts, there will be an impact on the NIM. And the earlier the rate cut would be, it definitely will not be able to pass on the entire thing, transmit the entire thing in any big way from a cost of fund perspective. But as matters stand, at the present rate, we really believe these 2 items on the liability side and 2 items on the deposit side would help stabilize and shore up the NIM in the coming quarters.
Thanks for that clarification. Let's move on and talk about your deposit growth, sir, because that has remained strong. But specifically, if we look at the trend, your CASA ratio has declined. Now, with improved system liquidity, will you be focusing on gaining the CASA deposits? Is there any target number that our viewers or investors can pencil in?
So, CASA has 2 parts to it. There is one part where we are proud of, the one which we need to work a bit more upon. The CA portion has decreased. Whereas on SA, we have grown 19.36 year on year. So that really helps improve the cost of fund. But on the current account piece by itself, we have taken a hit over the year. We have introduced new products. We have introduced UPI-based cashback program for our savings account customers. We're encouraging transactions for our customers. The whole idea is to concentrate on customers who are using savings account for the purpose of transactions rather than the purpose of investments. So while we have a high end, at the higher end, our savings account rates are high. The whole focus of the bank is to ensure that more and more customers transact. There's a bit of a look within policy where we're really working upon our existing base, not only the liability customers, but also the vast majority of asset customers. We're getting them to open savings account with us. We are encouraging them to transact with us. The whole idea is, our belief is over a period of time, engagement will lead to transactions, which will lead to higher SA balances. We're chasing the flow rather than the float. The other benefit of this particular strategy, of course, is that not only will you, when you chase the flow, you also get the benefit of cross-sell and better retention of the customer over a period of time. So our entire CASA strategy is focused on the savings account piece, and the belief is that if we do enough and provide enough customer benefits for getting the flow, the SA float will eventually happen.
Right, and we leave it there. Thank you so much, sir, and all the best for a brand new financial year for you and your bank. As we speak, the stock is actually in trade, 9% uptick on back of really good steady numbers in the quarter gone by. That was the management of DCB Bank.
If you like this video, then like, share and subscribe to ET Now.